Hello there, my name is Maddie and I'm an economist at the Reserve Bank of Australia. This video provides a brief summary of current economic conditions as published in our November Statement on Monetary Policy. So let's start by looking at the global economy. Inflation has persisted around multi-decade highs and remains well above central banks' targets in most economies, underpinned by strong demand, insufficient supply, and large increases in the prices of energy and food commodities over the past year. This graph shows the contributions to headline inflation for the US and the euro area. Headline inflation appears to have peaked in the US and many other economies outside Europe. This is due to recent falls in oil prices and an easing of supply constraints in goods and shipping markets, although energy prices in Europe remain very high. Core, or underlying inflation, shown in light and dark orange, which exclude more volatile energy and food prices, remains elevated across most advanced economies and is yet to show any clear signs of easing. This is because high core inflation has been underpinned by a rise in services inflation, such as the light orange bars, driven by strong demand for services and wages growth. Central banks in most advanced economies have continued to increase their policy rates rapidly. This is to address high inflation and lessen the risk that it becomes embedded in wage and price setting behaviour. Several advanced economy central banks have signalled that it is likely their policy rates will need to be increased further to return inflation to target. In this graph, we can see that market participants have markedly revised up their expectations for further increases in policy rates by most advanced economy central banks, where the darker dashed lines are current expectations and the lighter dashed lines are expectations as at the August Statement on Monetary Policy. These revisions have been in response to evidence of persistently high inflation and tight labour markets in these economies. Policy rates are now expected to peak in the first half of 2023 and then decline from the second half of the year onwards. Uncertainties surrounding the global outlook continue to be large and are tilted to the downside. The middle panel of this graph shows that forecasts for GDP growth in advanced economies over the next couple of years have been lowered further from the grey dashed line to the blue dashed line as a result of stubbornly high inflation and expectations of tighter monetary policy. Growth in the Chinese economy is expected to be subdued in the year ahead, given the effect of the authorities' efforts to suppress the virus, as well as considerable stress in the property market. This has contributed to the downgrade to GDP growth in Australia's trading partners and East Asia you can see in the left and right panels, again shown by the move lower from the grey dashed line to the blue dashed line. Turning now to the domestic economy. The Australian economy had substantial momentum over the first half of 2022, and timely indicators suggest growth held up into the September quarter. The labour market is currently very tight, although there has been no employment growth over recent months, and firms are finding it challenging to hire workers. The participation rate in pink, which is the share of the population aged 15 and over who are employed or actively looking for work, has remained near its record highs. The unemployment rate in blue has remained near its 50-year low at 3.5% in recent months. Firms have also increased the hours of their existing employees, including by shifting part-time employees into full-time work to meet heightened labour demand over the past year. This has seen the underemployment rate in orange, which captures employed persons who want to work more hours, also move towards very low levels. While labour demand is strong, there are signs that it's easing slightly. Leading indicators of labour demand, including measures of job advertisements and job vacancies, are at high levels but have come off a little. The unemployment rate is forecast to remain around 3.5% until mid-2023, before rising as economic growth slows. As I foreshadowed a few moments ago, economic activity has strong momentum over the first half of 2022. This graph shows that the Australian economy grew by 0.9% in the June quarter. Household consumption growth was strong in the quarter. This was as spending on discretionary services, such as hospitality and travel, all in yellow, continued to recover from the restrictions and international border closures in place during the pandemic. Growth in GDP in the June quarter was also boosted by a rebound in exports in blue. Exports increased sharply as earlier disruptions to production in the resource sector eased. Construction activity, included in the grey bar, subtracted from growth in the June quarter, amid ongoing material and labour shortages, illness-related absences, and weather-related disruptions. Household consumption currently makes up around half of GDP and has been the main driver of the large fluctuations in GDP since the onset of the pandemic. The top panel of this graph shows the level of nominal household consumption and disposable income. The share of disposable income which households don't consume each quarter, known as the savings ratio, is shown in the bottom panel. The lines to the left of the vertical line are actual outcomes, and the lines to the right are forecasts. As we saw moments ago, consumption has led the increase in economic growth of late, thanks to the ongoing recovery in household spending on discretionary services. Strong growth in consumption saw the savings ratio decline further in the June quarter, but it still remains higher than before the pandemic. While strong labour market conditions are supporting household incomes, household budgets are under increasing pressure from rising cost of living and higher interest rates. Looking forward, GDP growth is expected to be 3% over 2022, before slowing down to 1.5% over 2023 and 2024. The forecast slowdown reflects the combined effects of higher consumer prices, rising interest rates, and declining housing prices. The recovery in household spending from pandemic-related restrictions, including travel, is also expected to have mostly run its course by early 2023. Although a key source of uncertainty for the domestic growth outlook relates to how household spending evolves. Wages growth has picked up further over recent months, and this is expected to continue in the period ahead. Firms in the bank's business liaison program have indicated that this has been driven by strong labour demand and the tight labour market, elevated staff turnover, and higher inflation outcomes. Also mentioned by firms has been the flow-through of the wage policy decision in June by the Fair Work Commission, an independent Australian body responsible for setting national minimum wages and employment conditions. The Wage Price Index, or WPI, grew by 2.6% over the year. Growth in the WPI is forecast to pick up to around 3.75% by mid-2023 and 4% by mid-2024. This would be the highest level of wage growth in over a decade in nominal terms. As is the case overseas, inflation in Australia is high and broadly based. Global factors have accounted for much of the increase in inflation over the past year. Notably, pandemic-related supply disruptions and Russia's invasion of Ukraine have raised the cost of a range of inputs over the past year, and these high costs continue to impact goods prices. But strong domestic demand, a tight labour market, which we saw earlier, flood-related disruptions and capacity constraints in some sectors are also contributing to the upward pressure on prices. The headline Consumer Price Index increased by 1.8% in the September quarter and by 7.3% over the year. The last time year-ended CPI inflation was this high was the late 1980s, before the RBA had adopted its inflation target of 2 to 3%. Inflation continues to be broadly based. In the September quarter, around 3/4 of the CPI basket grew faster than 3% in annualised terms. This graph shows the contributions to the growth in consumer prices over the year. You can see that a wide range of items have contributed to the strong inflation outcomes. To pick out a few, grocery prices, shown in blue, increased very strongly in the September quarter as supermarkets continued to pass through cost increases from suppliers. Heavy rainfall and flooding also affected the availability of many items, and so pushed fruit and vegetable prices higher. Price increases for newly constructed dwellings also remained high. And this reflected further increases in the prices charged by builders, who have faced increased costs for labour and building materials. They've been able to pass on these costs due to strong demand for housing construction. And market services inflation, which makes up just over 1/5 of the CPI basket and is in purple, increased to be around its strongest rate in around 3 decades in the September quarter, due to input cost pressures and strong demand. Price increases were particularly strong for restaurant meals and takeaway. Alongside high headline inflation, measures of underlying inflation were also very strong in the September quarter. Recall that these measures remove the effect of irregular or temporary price changes. In this graph, we can see that trimmed mean inflation was 6.1% over the year and 1.8% in the September quarter. These are the strongest outcomes since 1990. A further increase in inflation is expected over the months ahead. Headline inflation is now forecast to peak at around 8% and trimmed mean inflation at 6.5% later this year. Inflation is then expected to decline from early 2023 as global supply problems continue to resolve, which will help moderate cost pressures, and as higher interest rates slow demand in the economy. By end 2024, inflation is expected to decline to be just above the 2 to 3% target range. As we have seen, inflation in Australia is the highest it has been in over 3 decades. The Australian economy is expected to continue to grow solidly over the second half of this year before slowing in 2023. The labour market is the tightest it has been in decades, but household budgets are under increasing pressure from higher prices and interest rates. The board has stated that it places a high priority on the return of inflation to the 2 to 3% target range over time, as price stability, that is low and stable inflation, is a prerequisite for a strong economy and a sustained period of full employment. The board is seeking to do this in a way that keeps the economy on an even keel. Accordingly, and as we can see in this graph, the board has increased the cash rate target materially since May. This has been necessary to establish a more sustainable balance of demand and supply in the Australian economy, which is needed to return inflation to target. The board expects to increase interest rates further over the period ahead, but the size and timing of future interest rate increases will continue to be guided by the incoming data and the board's assessment of the outlook for inflation and the labour market. And so that wraps up our summary of the November statement on monetary policy. The link to the statement can be found below. Thanks for watching this update, and feel free to explore our website for more information, including some video explainers about key economic issues. See you next time.